I know summer days are slipping away, but are you financially ready for fall? Hi everyone, I'm David Scranton, and thanks for clicking on today's video. For most, summer is the season to relax, and for many, just forget about your finances. And that's fine, but summer is almost over now. And with that in mind, I'm going to share some smart financial moves for the fall. Actually, easy steps that you can take in the coming months to help make sure you're still on track to meet your retirement goals. So first, let's talk about taxes. Spring, yes, is tax season, but fall is when you still have plenty of time to take steps to help you save big on next year's tax bill. For example, fall is the perfect time to consider increasing contributions to your 401k or to other retirement accounts. Next, fall is a good time to familiarize yourself with year-end tax deadlines and to take advantage of these deadlines. Maybe rather than writing checks to your favorite charities in December to meet the deduction deadline, make a charitable contribution plan for the fall. You should also do a paycheck review. This is a great annual exercise to make sure you're paying the right amount of taxes upfront through your withholding each and every year. You can actually use the tax withholding calculator on the IRS's website, irs.gov. And with that calculator, you can figure out if you should adjust the amount withheld from your paycheck. Make a list of deductions you know or think you might be eligible for. Then ensure you're tracking those expenses. And finally, if you're over the age 72, make a plan for your required minimum distributions, or RMDs, if you haven't yet done so. And yes, everyone's situation will be different, but if you don't take RMDs by December 31st, you could face a huge IRS penalty. Now, speaking of the IRS, are you still waiting on a refund or outstanding money from a stimulus check? What about a reimbursement for overpaid taxes on unemployment income? Millions of Americans are. Check on that money this fall to make sure you haven't fallen through the cracks. You can find out if your payment is still processing, again, at the IRS's website, irs.gov. And if the coronavirus forced you to dip into your rainy day fund, begin rebuilding it. And if you don't have a rainy day fund, then start one. It should be a savings account with enough money in it to cover 3 to 6 months of living expenses as a general rule. In an event like the pandemic, it could be what saves you from dipping into your retirement accounts and getting hit with a huge tax penalty for doing so. And lastly, review your progress toward your financial goals. Sadly, many Americans did have to pull from their retirement savings during the pandemic. And even if you weren't one of them, reviewing your retirement strategy this fall is important. Why? Because the pandemic changed the financial markets, and more big changes could still be in store. So with that in mind, this fall is the perfect time to revisit your investment strategy to see that it's providing you with enough protection and enough flexibility. Better protection in case autumn brings on another major stock market correction, which analysts believe is, generally speaking, overdue. And also bring you flexibility so that you're well positioned to take advantage of any market changes that occur before year's end. So don't wait long. Make an appointment with the right advisor immediately after Labor Day. And finally, I believe the smartest financial move that you can make this fall is to commit to learning about all of your savings and investment options. You may think you know about all the financial tools and strategies available to you, but in my experience, most people don't. And as a result, they use the wrong strategy, the wrong tool for the wrong job. Why? Because they just don't know a better alternative exists. And when I say better, I mean an option better suited to your situation, your needs, your risk tolerance, and also your retirement goals. Sure, you could know all about common stocks, all about stock mutual funds, and bond mutual funds. Those are probably the options you've used most often during your working life. However, there's an entire universe of other options that are available that can make a lot more sense once you're in or nearing retirement. This, of course, is what I always call the universe of income-generating strategies. And it's much broader and more versatile than most people realize. In fact, today's income specialists have a much larger and more dynamic range of tools and strategies at their disposal. The more you learn about them, the more you realize how the right mix can provide you with not just a good financial strategy, but the right strategy for your goals and objectives. So we want to bring in our special guest, Peter Schiff. He's the chief economist and global strategist at Euro-Pacific Capital, which is a division of Alliance Global Partners. Pete, thanks so much for being here with us on the Income Generation.
Oh, Dave, thanks for giving me the opportunity to come on your program.
Gosh, we spoke April of last year, right about the time that this COVID-19 crisis hit, right? And the stock market was terrible. And of course, you've said it's because we intentionally shut down the economy, and you're correct. But are you surprised to the extent to which the markets have recovered and created new highs over the last, 16 months?
Well, nothing surprises me at this point. If you print enough money, you can get asset prices, nominal prices to go up. And, this is really the mother of all bubbles. It's the everything bubble. And so that's what's going on. But what doesn't surprise me is the underlying weakness of the U.S. economy, the incredible increases we've already seen in producer and consumer prices, and we're just getting started. People are going to have to deal with much greater increases in the years ahead.
Sure.
Maybe what surprises me is how few people can actually understand what's going on. People are still oblivious to economic reality.
So, most people are hearing the news that the economy is doing wonderfully well, but you're saying the economy is having problems. Can you just elaborate so our viewers can understand why you're saying that?
Well, if you look at our trade deficits, they're all-time record highs. That's a big sign of a problem. Our economy is incapable of producing the things that we consume. Our budget deficits are at all-time record highs, so the government is borrowing more money than ever before. In a strong economy, we wouldn't need to borrow so much money. The fact that the government is relying on so much debt shows you that there's an underlying problem in the economy. Also, you have a lot of Americans that are absent from the workforce. Labor force participation is still very low. So you have a lot of people that prefer receiving government checks to paychecks because, to get a paycheck, you actually have to show up and do some work. But to get a government unemployment check, you don't have to do anything. You can stay at the beach and get paid. So the economy is very dysfunctional. They point to all these supply shortages. But that's evidence of a weak economy. We can't produce stuff. All we can do is spend money that the Fed prints.
Peter, when you were here just 16 months ago, you talked about inflation, how the government is essentially stealing money from American citizens by eroding the buying power. And for the last several months now, we've started to see that inflation. Question is, are you in the camp that it's transient and temporary, or do you think they're creating more of a long-term inflation problem with what they're doing economically?
Well, there's absolutely no chance that it's transitory. Remember, the Federal Reserve told us that the subprime market was contained. So inflation is as transitory now as the subprime problems were contained, back in 2008. In fact, the only thing that's transitory, I think, is the fact that inflation is going to get a lot worse. So it's just going to go higher from here because the government is spending all this money. Biden just unilaterally increased food stamps by 25%. Where does the money come from to pay for that? They've got this $1.2 trillion infrastructure bill. Where's that money coming from? They got another $3.5 trillion bill. Where's the money for that? Meanwhile, the cost of Social Security, Medicare is exploding. You have fewer people who are working and paying taxes and more people retiring every day. Where's that money coming from? It's all going to be printed. But just because the government prints money doesn't mean we escape taxation. We're just being taxed in the form of inflation. So instead of the government taking our money, they're taking our purchasing power. Everything we want to buy is going to cost more. And as a result, we're going to buy a lot less.
Okay, so all right, you said it there. As a result, we're going to buy a lot less. So I look at two things. To play devil's advocate, first of all, it's been slow, but eventually the supply chain issues should get corrected because corporate America wants to sell more goods and services if the demand is there for it. And secondly, I question what has really changed fundamentally for demand for goods and services. Is it possible that maybe just the inflation as we think about it is shorter term, but we create more asset inflation, like what's happened over the last year, and that continues, or real estate and stock prices just keep going up because people aren't spending the money, they're just investing it? I mean, do you see that as being a possible outcome as an alternative to traditional inflation?
No. Well, inflation is an expansion of the money supply. There's no new inflation or old inflation. That's all it is. The government inflates the money supply and prices respond by going up. Or, maybe prices would have gone down, but because the government expanded the money supply, prices don't go down. I mean, the government robs us of our purchasing power. Whenever the government creates inflation, prices are higher than they would have been absent that inflation. And so that is how the tax is paid. But, I don't think the problems can be blamed on supply. I mean, that's always the case. If you print a lot of money, you can always say, well, there's not enough supply. There's too much demand. Demand has to come from production. But if we don't produce to generate demand, if we just print, prices go up. I mean, there's never going to be enough supply. If we gave everybody $1 million and they all tried to buy a Ferrari, we could say, well, there's a supply shortage of Ferraris. Of course, there's not enough to go around. The price is going to have to go up if you just give everybody a bunch of money.
Okay. So, you have really two types of inflation, the way I like to think about it, where, again, you've got prices going up for goods and services, and then you have asset inflation because not everyone's spending the money, right? Some people are saving it, investing it, and that's what's driving up real estate prices and stock prices. So our show today is all about smart financial moves for members of the income generation, those 50 and over, for this fall. Bottom line, your crystal ball, do you think the stock market's going to keep climbing through the end of the year, or do you think people need to be really, really cautious with their stock exposure over the next 4 months or so?
Well, they need to be cautious with their stock exposure, regardless of whether the stock market continues to climb. And, it's really not asset inflation. Again, inflation is the expansion of the money supply, but prices go up. And what we have seen is asset prices have risen a lot more in the past anyway than goods and services prices. So you've seen that inflation reflected more in assets. And the other problem with that is when those assets, let's say, are your home, a lot of people will use that as collateral to borrow money and then spend that. And to the extent that people see the value on paper anyway of their stocks going up, they may feel less of a need to save. And so they may spend money that they otherwise would have saved because they're operating under the delusion that they're getting rich with the stock market going up.
And people borrowing more home equity means just it increases the chances of us potentially having another 2008 type crisis. So Peter Schiff, we got to leave it there for now, but thank you so much for being back with us here on the Income Generation. It's our pleasure as usual. Now it's time to bring in our next guest, income specialist Scott McLean. He's the CEO of McLean Advisory Group, as well as the Amazon best-selling author of his own book, Three Blind Mice. Scott, great to have you back, of course, being a great friend of the Income Generation.
Thanks, Dave. Thanks. Glad to join you guys.
Hey, so we're going into the fall here. People get a little lazy with their money over the summer. Do you see that they get more serious about their money in the fall, in that they get more serious about financial education in the fall?
Dave, I wish people would be more serious about their money, but you're right. It's so easy to relax in the summertime. It's so easy to kick back and not worry, and everything is everything. But I think I agree with you. I mean, education, people need to wake up. They need to really, as I say in the book, they are like an ostrich with their head in the sand. Nothing is exposed except their vitals. Not a good thing. Not a good thing.
No, not a good thing at all. Why is it you think? And I know you live, in a big summer cottage community yourself in New Jersey. So why is it people tend to get lazy when it comes to their money in the summertime, do you think?
I think it's just part of human nature, relaxing. It's summer. Give me freedom. I want to get out. Don't bother me. I'll get to it. It's almost they don't see the concern. Of course, they turn the TV on. They maybe get concerned all the stuff that's going on now. I don't know. Apathy is a very, very, very strong tool, as well as procrastination. And that's where a financial advisor's job is to really stay on top of people and really make them aware of what's going on. I think that's our job.
So what are some of the things that you do when you talk to your clients or you review with your clients in order to keep them focused on this and why this is such a serious topic?
We do a lot of different things, Dave, as I know your firm does. Number one, we do now educational webinars. Last night we had a workshop at a place, and we did the common mistakes of a senior. So we did that last night for actually the last 2 weeks. So a continual education. On top of that, we're doing, as you know, and as you well train other advisors to required minimum distributions, and just to make them aware of it. So security, there's so many different facets of retirement that, people forget to look at the basics. And I think it's our job to make them aware. So make the class enjoyable, make it fun, make it like I want to join this class. And the neatest thing is during webinars now, the simple thing is they can turn you off. It doesn't matter. You don't even know it. But the good thing is they have the right to, it's not like we didn't help our clients, being way, way more proactive than reactive. And I think that's the blessing in disguise, which will make people say, maybe I need to pay attention to my money. Let's take a quick listen.
Yeah. And it's funny, learning, the human brain learns better when it's having fun, when it's enjoying itself. The endorphins are released, and it allows you to absorb information. Now, and I know you always make things fun and interesting. So that's one thing that's consistent. This summer, though, thankfully, thanks to the Federal Reserve, if people got a little complacent about their investments, they probably did okay, because most investments did well, at least most stocks and mutual funds throughout the summer. How do you think that's going to go through the fall? Do you think the markets are going to continue to do well, or do you see some real concerns of a significant pullback before the end of the year?
We could have a little bit more legs in the market. We could see a little bit more uptick in the market, but there's so many things that are impending on the next 2 quarters. I am nervous about it. Nervous in the sense of I'm not going to freak out and scream and yell, but we are paying attention to it. Could we have some more growth in the market? Well, there's so many things that are against it, such as the new COVID deal, the new Delta virus. And now people are emotionally getting involved, and emotions have a way of getting away from you, and they doing things you shouldn't do. This is where a financial guy or gal in your back pocket, a financial advisor, can guide you through it. I do see the market's going to be more turbulent. There's a lot out there, Dave. So if I had my crystal ball and it was clean, well, it was clean up until now, but now I see a lot of more. We don't know what the president's doing with the tax bill. We see just recently what's happening overseas, and these poor people that are getting just terrible. So paying attention to your home front first, then of course, do I see the market going up? It's possible. It could have some more little bit of legs. There's a lot of cash on the streets right now going nowhere. But
sure.
Well,
I know it's great. You always talk about the 3 blind mice when the financial advisor, the investment advisor, doesn't talk to the attorney, doesn't talk to the tax professional. And right now, with the new tax code coming out, it is not a better time I could think of to go to Amazon.com and order your own copy from Scott McLean of the 3 blind mice. Scott, thanks so much. It's always fun to have you. And hey. Congratulations. Look forward to having you back.
Thanks so much for having me, Dave.
Now let's bring in our final guest of the day, and that's income specialist Drew Pelton. Drew is president of Drew Pelton Investment Services, a retirement income store located in Baton Rouge, Louisiana. Drew, thanks so much for being back with us, of course. Always a pleasure to be here with you.
Thank you, Dave. It's always a pleasure on my part, too.
So, I know we all enjoy summer. You like to enjoy summer. I like to enjoy summer. Actually, I take that back. You're more of a workaholic. You love so much helping people that I don't think you take much time off in the summer. That's how you're wired. But why is it, do you think, most people don't take their personal finances as seriously in the summer as maybe they do other times of the year?
Well, I think that a lot of people generally have a hard time facing the realities and the facts of their money. And particularly when there's a lot of things going on in the world, and without listing all those things that I think are quite obvious, whether it's Afghanistan or it's people coming across the border or COVID-19 resurgence, all those things, and people tend to run scared, I find. And so I'm sure certainly it's easy to enjoy themselves and look the other way and not pay attention to what I think is critically important to pay attention to, which is your money. It's your money, your retirement, your life. You got to get it right, and you should never take your eye off the ball.
Yeah. So how do you, I know you're a big financial literacy proponent, and you help people in the Baton Rouge area learn as much as they can about finance, especially income-based investments being part of the retirement income store. So what do you plan in the fall, starting right after Labor Day, to really help increase that level of financial literacy training that people in your area could benefit from?
Well, certainly for clients, we recommend doing a review and analysis to make sure that everything is in line with their goals, their objectives, and their needs. For those that may be looking at help from our firm for the first time, we do take them through an educational process that helps them understand that for most, gambling with their retirement dollars may not be the best thing to do. I find so many people that have more risk in their portfolio than they say they want. And so we help people understand how much risk they're taking and compared to what they want, as well as we help them understand probably the necessary shift they need to make from investing too much for capital gains and capital appreciation to more investing for income, investing more for stability, investing more for predictable, dependable income at yields, dividends, and interest that are at levels they need to get the job done. Certainly when people have mutual funds and exchange traded funds that might only be generating 1 or 2%, that's normally not going to get the job done. And it seems to me that a lot of people are throwing around the inflation number of 5.5%. And so whether we say it's 5.5 or 5, that's a much bigger number than it's been. And if you don't plan inflation, you could get yourself in big trouble.
Very true. So look, I know you're such a fan of educating people that I understand you're writing your own book. So it's a work in progress. Give me 1 or 2 of the things that you want people to really know when they read your book once it comes out.
The formula of TR equals I plus G, total return equals income plus growth, and understanding the difference, that is essential. And understanding how to make the shift from this growth accumulation phase type of investment strategy that may work while you're working in your working years, making that shift to the distribution phase strategy of your life when you're going to have to take money, whether you need it or required minimum distributions, force that to come out of your portfolio. Making that shift is critically important, getting your investment strategy correct for you in retirement.
And Drew, one would argue that's probably the biggest potential mistake. So Drew, I can't wait to read the book when it comes out. I'm looking forward to it. And once again, it's been our pleasure for having you back with us here on The Income Generation.
Always a pleasure, Dave. Thank you.
And a big thank you to you for watching. Bottom line is, if you enjoyed this interview, please make sure you give it a thumbs up and subscribe to our YouTube channel for new content each and every week.